Hello and welcome to Creative Outcomes. I am your host, Ryan Watson, partner at Upsourced Accounting, and I am joined today by fellow partner Craig Baldwin. Craig, how we doing, buddy?
Great. What a privilege to be with you today, Ryan.
It's always a great time, isn't it? And we have a fun topic, one that's very near and dear
Yep.
to our hearts,
Yep.
which is compensation structure for partners. I mean, I don't know about you, but I feel like as I'm out there, a question that often comes up is just like, how should I be paying myself as a partner, or how much should I be paying myself? And all the kind of accoutrement that surrounds that particular question. And so I don't know. Felt like today would be a good a day as any to tackle it head on and provide some answers to some of these.
Yep. Yep. And I'll just say that sneakily, I think many times when our clients ask us, how should I pay myself as a partner? What they're trying to figure out is what are other partners making?
Yeah, exactly. Yeah, exactly. How does this line up? Should
Which
I be paying myself more?
I totally appreciate that. I totally
Yeah.
appreciate that. But it is, while it's not a complex topic, I will say that in my opinion, it can be kind of stylistic in terms of how the partner wants to manage their own cash flow, what type of latitude in decision making they may have. Are they a solo owner? Do they have partners? Can they take out as much as they want? Should they leave some money in the business? And of course, that impacts how partner compensation may work at any one firm, right? So it is it is not a clear cut activity. I do think it rides very close or in parallel to forecasting overall business performance because that will dictate what type of capacity we have to pay a really meaty salary and or really meaty distribution throughout the year at the end of the year.
Well, so I think, yeah, listen, I agree with that wholeheartedly. And as you're talking, it makes me think like, well, so that we can get into the conversation about how much to pay and how to pay and all the mechanics that surround it, we should also be very careful that we are on the same page about who we're talking about. Like if we're saying partner com partner compensation, what do we mean by the term partner? Because I think in agencies you hear that described used to describe varying kinds of people who have seats at the table.
Yep,
So I think for the purpose of this conversation, I would say let's limit it at least to start to the equity holders of the
that's right.
organization, the
Yep.
true pure equity holders. And therefore, this would not include maybe that, director or quote partner that you've added on and is maybe a phantom equity holder or has some other kind of profit share or whatever. We're talking, hey, we get a K1 or we're on the physical tax return. That makes sense.
Yeah. Yeah, absolutely. Absolutely.
All
So
right. Well, listen. Yeah. Let me start with just when I hear this question. By the way, like my initial reaction to like how much should I pay myself is um, the maximum amount possible. I think. I mean, that's my answer. I don't know if that's your answer. You should pay yourself as much as you
Uh,
possibly can. I mean,
yeah,
which obviously is. I mean, listen, my like more academic answer. Tell me if this agrees with you, but it truly is like, listen, if we're talking about pure equity holders, and generally speaking, let's say we're also talking about because I think as a secondary issue here, the topic of like org structure will influence the amount and more specifically the mechanics behind how we pay. But if I just ignore that for a second, the vast majority of the clients we work with are pass through entities of some kind, LLCs, taxed as a partnership or an S corp. Um, my overall attitude is listen, your organization needs a certain amount of cash reserves in order for you to sustain the ups and downs endemic to what is likely some project-based cash flow. And so you've got to keep enough cash in the bank to meet your cash reserve target. And then every dollar after that, you should take it. Take it as salary, take it as distribution, who really cares? But that's the every other dollar should go to partner compensation. What do you think about that, Craig? Is that your mentality, or is that what you see, or how would you edit that?
generally speaking, I would agree with that, especially in a situation that as the owner or owners in a pass-through entity, you will receive a tax bill based upon the income of the business at the end of the year. And so you want as much cash in your pocket, so to speak, in order to cover that tax bill. We will talk about quote unquote tax here a little bit later in the podcast. The only caveat I could see or think is if there are extenuating circumstances which may require additional cash for whatever reason, whether that's, hey, you're trying to well, something pertaining to the business that would be an expense or investment, which would dictate hoarding cash. I'm using that term generously, to then pay for. And hopefully that payment is within the current tax year or fairly soon, right? Because I'm not a fan of letting a bunch of cash or too much cash sit in the business to the extent that it makes sense to use an owner's income via the cash in the business to pay for those things versus a line of credit or debt or any other number of things. Those are all kind of very simple spreadsheet exercises. But generally speaking, I do agree. We do not run inventory heavy businesses as professional service owners. There are situations where this may not be the case. I can think of like a media or production situation where I have a lot of funny timing of pass through expenses. And so maybe I'm a little bit more sensitive to how much cash I pull out at any one given point in time. But otherwise, I'm trying to maximize that distribution every single quarter or every single end of year in order to make sure that I can cover any tax responsibilities that I may have. And of course, hopefully earn outsized reward for being the business owner or one of the owners.
Yeah, I agree with you wholeheartedly. I thought that, yeah, the build is a good one where you may have, so in a traditional environment, I have a cash reserve target. That cash reserve target is whatever it is, 2, 3, 4 months of fixed monthly operating expenses, depending on, the nature of your business. But there might be situations where my cash reserve target needs to be larger because I either, I can think of a client where we'll front some media and there are kind of drive periods where we're going to have more media that we have to front. So we would inflate our cash reserve target for that period of time, which would decrease the amount of available cash for distribution. And same with, some future initiative, investment, opportunity, whatever. You just kind of add it to your cash reserve target and then distribute everything on top of that. Because to be honest with you, when you don't do that, we often get these really goofy questions around like, hey, I've got, X number of millions of dollars of cash in the bank. And it doesn't make sense for this to just sit there. So, like, what should I invest it in? Like, what should my business be investing in? And it's like, hey, listen, yourself. These are personal questions. Like,
Go see your investment advisor,
distribute it.
get that money out of the
Exactly.
business. Yeah, yeah.
Because then you get in these situations where partners who have different asymmetrical personal living situations, they have to now come together and agree on like how to invest money. And I just don't think it's not the purpose of the business. Like, we exist to service clients in a creative context. We don't exist to like buy assets or invest in the S&P. That's not what we do. So take that out.
Ryan, what would you say to a client who asks you how much of my compensation should be via some sort of regular paycheck, whether that would be a traditional W 2 because it's an S Corp, or perhaps just a distribution that's made on a regular frequency, versus like what we might consider a profit distribution, where I'm maybe doing a calculation to determine how much money did we make in a period of time and can I send a quick ACH to myself given the performance of the business? How do you provide recommendations to clients about that?
I had this conversation this week. So I will say what I said on that. So at first, it depends. Now we're getting into. So let's just take a quick side combo about um, org structure. Now org structure matters, and the answer to this question will depend on whether you are an S corp or a partnership. Again, for the purpose of this conversation, I'm going to assume you're not a C corp, even though we do have a couple of C corp clients, and that's its own thing. For the purpose of, so if you are, and without going into like the details of the difference between an S corp and a partnership and why to do one versus the other, the big benefit of an S corp from a tax perspective is the ability to specify a salary. So if you're a partnership, you can't take a salary. You are taxed on all of the distributive net income of the business at the exact same rate. That includes your federal, state income tax as well as self employment tax. For an S Corp, you are taxed on your salary differently than you're taxed on all the earnings above your salary. In other words, you only pay self-employment tax on the salary component, and you do not pay self-employment tax on the non-salary component. So if your distributive net income in your partnership, like let's say it's a one owner business, you made $500,000 in a partnership, that whole $500,000 is taxed the exact same way. If it's an S corp and your S corp salary is, let's say, $200,000, then you are taxed. You pay self-employment tax on that $200,000. You do not pay self-employment tax on the $300,000. For that reason, um, you as an S corp owner are incentivized to reduce your reported salary to the smallest possible number, right? Because that represents the largest possible savings. You want that extra self-employment tax to be on the smallest possible number. And so, of course, your incentive is to reduce it down as much as possible. The IRS's incentive is for you to increase it to the largest possible number. And ultimately, the guidelines are you have to pay yourself kind of a reasonable market-based salary. And so if you are an S corp, your job is to pay yourself the smallest reasonable market-based salary. There's no bright lines on this, but just think of it as like, what would it cost me to replace my role in this organization with somebody else? That probably comes on a range, and you're likely to try to pick the smallest rational number along that range, right? It has to be reasonable, has to be supported by, market data, but you want it to be the smallest possible number. So if you're an S corp, you should set as your salary the smallest possible reasonable salary number, and then everything else should be distributions. If you are the only thing I'll say is if you're a partnership, it doesn't matter. None of that stuff matters. It's all the same. And so if you're a partnership, then really I think you should pay yourself the maximum amount per month or quarter, such that the probability that you overpaid yourself in Q1 and then you had a bad Q2 and you have to send some money back is relatively small. Does that make sense? So like, you may not, like, if you're routinely making, let's say, you've got two partners, you're routinely making $400,000 in net income a quarter, $200,000 a person. You may not be paying yourself $200,000 in salary per quarter, but maybe it's like 100 or something
190.
like that. Yeah.
Yeah, totally.
Yeah. So anyway, does that make sense?
It does. I think again, I'm just adding a quick caveat to the S corp payment is if for whatever reason, and this is easily solved, but if for whatever reason you are relying on that wage, that paycheck via the S corp to also just provide for your living standard, and you just need a little bit more cash in the paycheck, and you may do for whatever reason distributions on a different frequency, then I could see saying, yeah, you know what, I'll take 150 versus 125 or 160 versus 140, right? I think a lot of what clients do is they come to us looking for some type of heuristic. They want to know, well, what should the number be, whether it's an S corp or even just a regular pass-through entity, where all of the income is a distribution. And the answer I would give is, how much do you need to provide the quality of life that you have, and does that reconcile with the performance of the business, right? Yeah. One quick question as a follow up: is there any consideration that I should make with relation to that, what I might call a salary, even if it's an LLC that's just a pass through entity, not taxed as an S corp, if I'm going to sell my business someday? And so what I'm trying to ask is, would I assign some amount of a quote unquote owner salary as a part of my overall compensation, just to set an expectation in the P&L? Or I guess, technically in some cases maybe not on the P&L, but how would I handle that situation? And should I be mindful of it, or does it
Is
not
there a
really matter?
precedent that's important to set? Yeah. Listen, my attitude on this question is no. I don't think so. This the same conversation I had before was that way because the reason asked that same question and my answer was the same, which is I don't believe so. And the reason I don't believe so is sort of twofold. First of all, like when you go through an acquisition, you're going to have this process where you're going to adjust the stated earnings to an adjusted earnings to normalize for both the buyer and the seller, like what's the true nature of this business. So, like for instance, if you had a bunch of personal expenses that you were running through the business and that was artificially deflating your profitability, you would go back to the buyer and say, listen, you can't include this, $12,000 of like steak dinners that I was paying for my wife and I on the business. We got to add that back, right? We got to add that back because once you buy this thing, you're not going to be spending 12,000 on steak dinners. And so it's going to be more profitable for you. And that's ultimately what this is about. So owner compensation is maybe like the first place where this happens, where if you're paying the owner $300,000, you're going to subtract that to say, listen, yeah, I was taking 300,000, but a market-based salary would be, 150. So we're going to add 150 back. And oh, by the way, if I wasn't taking a salary, the buyer is going to say, we're going to have to subtract some amount for a reasonable salary because I'm going to have to pay for that when you're gone. And so you're going to get to this market-based number anyway. And then, listen, if they want to keep you on, then that's just a separate now salary negotiation. I don't believe what your precedent would influence your sort of future negotiation for how much you're going to get paid on the other side of this thing. Anyway, so yeah, I would say don't let that be the tail that wags the dog.
Yep. Okay. That's really helpful. Last question. In terms of the frequency of, so obviously, let me take a step back. If I'm paying a paycheck because I'm an S Corp and I'm taking $150,000 a year, I'll get paid on whatever frequency that my payroll platform provides for or that I select. In the case where I'm taking profit distributions, do you have any opinion on how frequently I should be doing a calculation to determine what are my profits and what money can I take as my effective compensation as the owner or partner in the business?
Yeah. I mean, again, I think it like in a perfect world, you would be doing it quarterly. I think taking distributions more frequently than quarterly is just really noisy. Like monthly profitability can really vary. And so I think that's a bit of a fool's errand. I think in a perfect world, it would be quarterly profitability. But if you have an organization that has a high degree of volatility quarter to quarter, and specifically you're running an organization that like some organizations are very profitable. All the owners are definitely going to get distributions and might get big distributions. Okay, those are probably paying those out quarterly. But if you're running an organization that's maybe not as profitable and you're not sure that you'll even get distributions, it'll depend, then it's likely that you're not probably going to be in a position to pay quarterly because of the volatility quarter to quarter. Again, you really just want to avoid being in that situation where you have to give money back. Not that you couldn't, you certainly can. It's just psychologically not very fun. And mechanically, it might not be possible depending on your lifestyle and what you choose to do with the money after you take it. So, again, I think it really just boils down to your confidence level of like that this excess cash will remain excess cash for the next period.
Ryan, one question that I actually just got last week when I was with a client in person, but we've seen a lot of interesting behavior over the years, especially in situations where, for whatever reason, there may be a significant amount of cash in the business. However, a lot of that cash may not actually be from profit. It may be from prepayment of revenue or money that should be allocated to other hard costs, but you just have the cash, again, likely in a prepayment or unearned revenue situation. Or perhaps you have some type of line of credit or debt facility which has provided cash to the business, but does not represent profit. And I think you know where I'm going with this. How, and not to make this a tax podcast, but in relation to my basis and what basis means as a business owner, how weary or considerate should I be of my quote unquote basis once we define it for the audience? And is that something I should be constantly analyzing as a part of my profit distribution? to myself in relation to the business's overall performance.
So, quickly, I just want to like for the audience who's listening who maybe doesn't know exactly what basis means. Basis is basically just like my capital account in the organization, right? Like day one, my basis is 0, and then it goes up if I put money into the business. It goes down if I take money out of the business. It goes up if the business makes money. It goes down if the business loses money, right? And ultimately, as Craig was alluding to, I don't want my basis to go negative because there are negative tax consequences to my basis going negative. In most businesses, my basis cannot go negative unless I'm taking money that's not meant for me. And so, in other words, I borrow money for the business and I distribute that to myself. Or a client prepays money that ultimately is going to have to go through to pass through costs or whatever eventually, and I take it as a distribution, which is just another version of a loan, right? It's just a customer loan versus a bank loan. My advice there would be you shouldn't avoid doing that because of basis. You should just avoid doing that because it's a really risky thing to do. You're borrowing money. Like that's not a distribution. It's a loan. Like you are now borrowing money from the organization. You got to give it back. And I mean, man, we have, and I know we have seen these situations where organizations have taken large debt facilities and paid themselves and then are totally upside down. And it is a fast track to bankruptcy and lawsuit. So I think as a rule, if you have bank loans or customer loans, you should be segmenting that money for the purpose of calculating your like distributable cash. Can't take that money. I mean, again, especially for like prepayments for things like hard costs, like I feel fairly strongly about explicitly segmenting that like in the balance sheet or in the reporting. So it's just very clear this is not my cash. I'm just holding on to this for a minute. Yeah. But yeah, man, that can get really sticky.
Yep. Just something to consider. So another question that I have, and just as a follow up on this primary topic, if I am an owner, we're both owners, along with our third partner Ryan Baker in Upsourced, and we take, in our case, we do take profit distributions on top of a salary, that we effectively it's an amount of money which we pretend as a salary for, yeah, guaranteed payment on some frequency of time, and then we will, given the stability of our business, we will usually analyze quarterly to do profit distributions on top of that, right? Now, that coincides for most owners with estimated tax payments that I have to make or maybe should be making depending on my own personal financial situation, other businesses, etc. As an owner in Upsource, let's say that I've received some pot of money, that is my pro rata share of profit distribution. Should I come back and ask for more money to pay my taxes? Or is the expectation that I use the sufficient profit share that we have distributed as the means to pay taxes? And I think you know what I'm asking, because we also see this a lot where money is dispensed to owners and then they forget about their tax bill and they come back to the business and say, I need more money to pay my taxes, right? What are your thoughts on that?
Yeah, I do have thoughts on that, and I actually wrote that down to talk about, and then you asked me. Um, yeah, so well, first of all, and listen, I understand why people do this, and so I'm not here to say don't do it or you can't do it. But what complicates this, let me say, the simplest way to handle this problem is to distribute all of your profits, right? So again, I'm going to get taxed on my share of the profit in the business, whether that profit is distributed to me or not. But what makes it really simple is if it is all distributed to me, well, then I have all the cash and I can give whatever that portion of it, 30%, to my taxes. That's the simplest way to handle this. Distribute all the profit and then use the profit to pay the taxes on the profit. Now, what happens a lot of times is like the organization, and in that situation, that's me. Like at Upsourced, I'm writing my own check to the IRS. Craig is writing his own check to the IRS. The business is not writing the check to the IRS for the purpose of convenience and simplicity and all sorts of things. It is not uncommon for the business to write the check to the IRS on behalf of the individual. Because remember, in a pass through entity, the business doesn't owe the taxes. It's the person that owes the taxes. So the business is writing the check just as a convenience. And I don't love that because I think it muddies the water. It makes it unclear how much of that bill should have. It what is problematic about that, what is nice about just distributing the profits is Craig might have a completely different tax situation than I have, right? Craig might have all kinds of things that have been able to lower his tax bill, and I might have all sorts of things that increase my tax bill. And I don't think that should be his problem or my problem, right? We should each just have to be on the hook for our own tax consequences. And so when you just distribute all the profits and you just say, listen, you pay whatever percentage of that the IRS is asking for. If Craig's is 25 and mine's 40, that's our problem. But when you pay it out of the business, it becomes the business's problem. Craig's situation becomes my problem. My problem becomes Craig's problem. And I think that creates a lot of unnecessary and unintended consequences. So that would be the downside of doing that. Don't like it. Don't like doing that. I guess the only sort of caveat here would be if for whatever reason the business is not distributing all the profits, then the business needs to at least distribute enough to cover your tax bill. Does that make sense? So like some organizations just may not be making distributions for whatever reason. You just made that choice.
And we, like you said earlier, there could be some need where I am gonna keep cash from the profits in the business, right? And that I need to cover. I have something upcoming that I know I need to cover, right? So in that case, I may leave excess profit, so to speak, in the business in the form of that cash. But to your point, I just need to make sure I'm taking out enough to cover taxes then.
And usually a good operating agreement will stipulate that every partner should receive at least the maximum marginal tax rate. So let's say it's 40% times their share of the profits. So there must be mandatory tax distributions. By the way, it's the same for everybody, regardless of how much Craig ultimately pays and I ultimately pay. We pay each other the same amount such that it's sufficient to cover the taxes at a minimum. But yeah, so that is how this should be handled, and not some expectation that the business is supposed to cover the taxes. The business is not supposed to cover the taxes. It gets really messy. Hey, let me ask. I know we've covered a lot of this. Maybe we've covered all of it, but I'm curious about. I keep thinking back to the first question that one of us asked. I think you, which is like, how much should I be paying myself, and ultimately, what is everybody else paying, and am I paying myself enough? Like, am I paying myself enough? And I think I think there's like there's an easy conversation, which is the business has money. I just need to figure out how much of it I should be giving myself, such that it's fair. But there's also the harder conversation where it's like the business doesn't have money, and I'm paying myself what I can. And that may or may not be in my best long-term interest as like you know, a cog in the, labor force. So I guess I'm curious how you would think about as a partner. Like, let's say I find myself in this situation where the business is just not generating a lot of money and I'm paying as much as I can, but it's like, whew, it's a bit of a slog. Like, at what point would you say, hey, you know what? You are paying yourself the most you can, and that's maybe not a good idea anymore. Like, what would be, what do you think is like how would you think about what is enough for this all to be worth it even?
Yeah, and that's the real question in my opinion, because I think it easily gets lost, especially for first time or young agencies. When I say first time, I mean first time business owners, is that there is a perceived allure to being a business owner. It feels good. It is a status symbol to my family, to my peers, to the rest of the business community. And so, because of that, it's not uncommon for us to see owners who really love being owners, but then forget that they need to make enough to support their family, or their own expenditures. And so they will go prolonged periods of time without adequate compensation. Now, this certainly gets into personal finance pretty quickly, but if you cannot consistently replace what you think you are worth as an employee on the open market in your business, then I would give yourself some type of expiration date to work towards when you finally say enough is enough. And it may just be in your best interest to go get a job, if I'm being completely transparent. Um, as a business owner, there are many fulfilling things when it comes to running a business, but you as that owner are taking on, or owners, more responsibility, more headache, more anxiety, more risk. You have all the risk effectively, right? Than any of your employees. And so I see this very commonly, that an owner will want to compare employees to themselves or themselves to the employee, and they feel guilty about taking money out of the business. They feel guilty about paying themselves all of the profits that we just talked about. And I think you gotta get over that, to be honest with you. I think you have to get over that. We, as business owners, go to great lengths to provide an environment for our employees, to provide opportunity to deliver great work, and that should come with outsized rewards, granted that the business has produced it, right? And so for the average professional in an agency landscape who's running their own little agency, but could probably go back in house and get a job at a big agency, or get a job in house at a large corporation. I mean, if you're not consistently making 160 to $250,000 a year as someone who's in the middle of their career age, um, or middle of their prime working years, then I think you need to ask yourself some tough questions about the agency that you're building. Now, there are periods of ebb and flow. There are periods where you think that the thing that you have built, while maybe not producing profit right now, such you compare yourself, still has enterprise value. That is to say, it could be sold. And that sale would be a windfall of cash that would make up for the shortcomings of a salary, right? Those are all very real conditions that we see owners face all the time. But if you do not have the requisite enterprise value in your organization, if you have gone prolonged periods of time without making what would effectively be at least the salary you'd expect to make in the open market, then there is no shame. And let me just reiterate that, because you and I have both been in this situation in other businesses. There's no shame in walking away and saying, this isn't right. I need to do something else, because I see too many owners um, go to wits end to protect everyone else but themselves, right? And I think that is one of the biggest mistakes an owner can make. I- we always hear the phrase, "You got to put on your own oxygen mask before you put on everybody else's." I think that's especially true when running a business. Otherwise, you will eventually run out of time, energy, money, or just motivation to keep showing up and doing great work every day.
Yeah, and I just think it happens. It happens without you realizing it. Like if you're in this situation where you're not earning enough profit, it's likely that you've had business hardships and declines and challenges, and you become so fixated on like putting out that last fire, and your purpose becomes survival. Like you're quite literally in survival mode in a professional context, and all you're focused on is like, what maneuvers can I make to keep this thing alive? But you've lost the forest for the trees, and you've forgotten why you did this in the first place. And listen, there's all sorts of, as you said, there's all sorts of like secondary, third, tertiary benefits of owning your own business, compared to like going and getting a job. But like the primary reason is to earn a profit. The primary reason is for you to make a living. And if you're not doing that and you've lost the path to doing that, you just got to stop and ask yourself, whoa, 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 wait a minute. Where's this even going? Like, even if I can survive, is that the goal? It's not the goal. So anyway. All right, Craig, what
Can I ask? I just want to touch on one quick topic before we exit that I think is also can be sticky, and that's really about like what's right in terms of what every partner should get, and what type of alignment should I have, whether that's informally in the yeah, I've made somebody 20% owner, but we haven't put it on an agreement yet, versus formally, which is yep, we're getting our ownership or our operating agreement drawn up right now, or anytime I add new partners, I'm going to make those changes right away. Like, do you have any high level thoughts about what it means to be a partner in a business with other partners, and how you manage expectation and how you manage bringing in new partners? What do you think is successful in terms of behavioral traits and how you manage those expectations? And what have you seen that has not been successful and has led to bad outcomes for businesses because maybe partners did not have that alignment on what should occur or how much compensation should be paid?
Yeah, listen. Well, first of all, your setup for the question, which was like kind of the formality of like, we're gonna have a handshake. You own 20%. We'll figure it out later. Versus like, we have a high degree of formality, and we've created a subscription agreement, all that kind of stuff. Uh, I often say I give this talk about the life cycle of agencies, and we talk about all the modes of the stages of life cycle or of agencies, and the early stages create mode, and what I'll say about create mode, which is 0 to 1 million in revenue, is that there's very few things that you can mess up, very few problems in create mode that you can create for yourself that I can eventually undo for you in a future stage. One of them is cap table problems. One of them is the thing that you just described, which is we had this kind of handshake understanding, and then it didn't, the business arrangement devolved, and that partner's not holding its weight. And now I actually don't want that agreement that I had a handshake. And now there's uncertainties, and it becomes really messy. So, I mean, you have to treat like there are a lot of things that you can over invest in starting a business and running a business, but I don't believe that you can over invest in, well, I mean, you can over invest, but I believe that you should put an enormous amount of emphasis on getting the operating agreement right, getting subscription agreements, and treating the admission of an equity holder with the utmost seriousness, because it is incredible. I mean, the tail risks that exist from screwing that up are enormous. And so, on top of that, again, like it's the reality. I mean, granted, there are things that you can do to mitigate equity ownership, like vesting. So, like, if you're going to admit a new equity holder to the organization, in fact, all equity holders should have some degree of vesting. And investing just means, like, you have the equity does not become yours until you stay a certain amount of duration. I think that mitigates the risk that this partnership that we thought was going to be great fell apart. So I would definitely suggest doing that. But that only mitigates so much of this. Again, you should just treat this. So often you see folks that are like, I met this person, and I'm a little bit lonely, or they seem great, and we should be business partners, without fully realizing how substantially life changing a business partner can be. And so, again, to your point of like making certain that you are ultra explicit on expectations for one another, expectations of the organization, direction, vision, how you'll handle certain decision making. You should not only have that conversation, you should be explicitly documented in an operating agreement. Again, I think I'm answering your question with more words than is needed. It is maybe the most important kind of thing that you can do. And like I said, I just don't think there's such a thing as taking it too seriously.
I absolutely agree. And I can't tell you how many conversations we have with clients and even backdoor conversations about their other partners or the structure they have in place and if it needs amended. Or I don't know how, I mean, it's probably at least half of the clients that we bring in the door, and we look at the flow of money, especially as we're getting onboarded, and we're like, what is this? And it's like, well, I had to buy out one of my partners.
Buyout apartment. It's so common. It's so common. And it's so expensive. And it is not, it's the last thing you want to do. I mean, period, really. Like, it's just not a great use of capital in the moment. Nobody's ever, anyway, yes. So guard the front door with regard to business relationships. There it is. Okay, cool. All right, Craig. I think we got this surrounded. This was good.
It
Anything
was
else you want to add?
fantastic.
No, I think this is
No, I
great.
think we've
Okay.
covered a lot, and hopefully at some point we can do a follow-up on a more tax specific conversation as it relates to being an owner. But this has been a fantastic intro to the topic. And if you have any questions, feel free to reach out to us.
Reach out, like and subscribe. Check out our other content on YouTube. Until next time.